Tonight, I'm helping you translate the cryptic and occasionally unfathomable terminology that makes owning stocks so darn difficult. Yep, I'm giving you the phrase book to navigate your way through the world of investing. Hey, but why do we call it the Michelin Guide to Fine Stock Timing? Consider it the televised encyclopedia Cramer for tearing back the cloak of mystery that can make managing your own money seem like an impossible task. The process of picking stocks shouldn't seem as difficult as, say, conducting triple bypass heart surgery on yourself. You don't have to be Stephen Hawking or Albert Einstein to understand this stuff. Although with the way a lot of the pros talk about stocks, I bet even Einstein would have a tough time figuring out what the heck they're saying. Now, I just explained the difference between cyclical companies, I think industrial smokestack businesses that need a healthy economy in order to grow earnings, versus secular growth names, think toothpaste, okay, that consistently expand at about the same pace regardless of where we are in the business cycle. How you have to sell the cyclicals and buy secular growth when the economy starts to slow. Then do the reverse as it starts to pick up steam. This is the playbook that all the hedge funds use. And even though these hedge funds can often behave like herd animals, wildebeests who often buy and sell the same stocks at the same time, they operate this way because their playbook works. The reason for that has to do with another piece of Wall Street gibberish lexicon that you absolutely must know if you're going to pick stocks by yourself. It's called the price to earnings multiple, or P/E multiple, or just the multiple. They all refer to the same thing, and it's the cornerstone of how we value stocks. In fact, when you hear talking heads pontificate about how some stock has become overvalued or undervalued, they're almost always really talking about the price-earnings multiple. When you hear someone say that Pepsi is more expensive than Coke, okay, they don't mean that Coke's cheap because it's trading in the 50s while Pepsi's trading in the triple digits. No, the share price tells you nothing about a stock's valuation vis-a-vis another stock. To make any kind of apples-to-apples comparison, you take a step back. See, when you buy a stock, you're actually paying for a small piece of a company's future earnings stream. That's what a stock is. So to value a stock, you have to look at where it's trading relative to the earnings per share, which you often see rendered as EPS. And that's what the multiple allows you to do. Now, here's the basic algebra, not even math, that any fourth grader, I think, should be able to do. The share price, P, equals the earnings per share, E, times the multiple, M. Okay? The multiple tells you how much investors are willing to pay for a company's earnings. We don't care that Coke stock might be at $55. We care that it sells for 19 times earnings. We don't care that PepsiCo, say, might be at the time 165. We care that it sells for more than 20 times earnings. Or to put it another way, the multiple is the special sauce of valuation. The main ingredient in that sauce, growth. How much bigger the earnings will be next year than they were this year, and the year after that, and the year after that, on and on. The stocks of companies with faster growth tend to get rewarded with higher price earnings multiples. Why? Okay, remember, the multiple is all about what we're willing to pay for future earnings. And the more rapidly a business grows, the bigger its earnings will be down the road. So if a fast-growing software stock sells for, let's say, 25 times earnings, that doesn't make it more expensive than a slow but steady grower like Pepsi at 20 times earnings. The faster grower actually deserves the bigger multiple. Now, here's where it gets real interesting. Price to earnings multiples aren't static. In different markets, people pay more or less for the same amount of earnings. When they pay more, we call that multiple expansion. And when they pay less, it's called multiple contraction. Two more terms that sound much more complicated than they really are. For example, whenever interest rates skyrocket, making the bond market competition a lot more attractive, we see market-wide multiples contract because everybody's future earnings are suddenly worth less by comparison. Of course, the earnings aren't static either. When you buy a stock, you're either making a bet that the E or the M part of the valuation equation is heading higher. So what goes in the earnings? How do you make sure that they're increasing and not about to collapse? Okay, here's some more vocabulary. When you hear people talking about a company's bottom line or perhaps their net income, they all mean the same things, earnings. We call it the bottom line because the number is the bottom figure on a company's income statement. To figure out how quickly a company's earnings could grow in the future, you have to look for clues when it reports its quarterly results. That's why I'm always telling you to listen to the conference calls. By the way, we do that homework for you in the Investing Club with all the charitable trust holdings. That's why I think it's such a good idea to be a member of the club. Step one to getting your head around the future earnings trajectory, you need to look at the top line. Oh boy, another unnecessary piece of Wall Street gibberish that's totally interchangeable with revenues, or more sales. They all mean the same thing. You want to see strong revenue growth, which tells you that there's demand for a company's product. This is ultimately the key to the ability of most businesses to sustainably grow their earnings long term. And that's why it's especially important for younger, smaller companies to have fast-growing revenues. Oh, and investors will really pay up for accelerating revenue growth. Accelerating revenue growth. Let's see, ARG. ARG, which means the sales are growing at a higher and higher rate. With a more mature company, it should be able to turn its revenues into profits by cutting costs, and then it can return those profits to shareholders in the form of dividend or potentially a buyback. Beyond the top line and the bottom line, it's also crucial to consider the gross margin, which is in no way disgusting and not the least bit marginal. The gross margin tells you what's left after you subtract the cost of goods sold from the sales. It's a key profitability metric. To figure out the gross margins, you have to consider the competition, the cost of production, and the cost of doing business in general. Businesses with cutthroat competition like supermarkets tend to have terrible margins, while a virtual monopoly like Microsoft has margins that are downright they're obese. In some industries, the margins can vary widely. Take the oil business, where the margins swing up and down with the price of crude. In that case, you need to watch supply across the whole industry. Oil production for energy inventories for retail, too much oil pushes price down. Right? Too much retail inventory forces stores to discount their goods aggressively in order to make space for the new merchandise. Both are what we call margin killers. So here's the bottom line. You need to know the vocabulary before you can evaluate a stock. When you're comparing, look at the price to earnings multiple, or PE, the growth rate, the top line, the bottom line, and the gross margins. I know this might sound basic to many of you, but I'm here to educate people, and I don't want anybody trying to pick stocks without a firm understanding of the basics. It's another great reason, by the way, to join the CNBC Investing Club. Mad Money is back after the break.
Coming up, finance is full of $5 words. But don't despair. Cramer's breaking down the Wall Street lexicon. Some key terms made easy. Next. Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.